Hi there, welcome to kneppyinvests. A couple of months ago, I decided that I was going to do a video on every single company that achieved an operational cash flow positive June quarter. Unfortunately, I didn't realize there were going to be over 120 videos I would do if I was going to do a standalone video on every single company that achieved this important milestone. And to be honest with you, I just did not have the time and capabilities to do a standalone video on all companies that did that. So I decided that I would do these group videos and combine at least 4 companies that did achieve this important milestone into the one video. And this video is one of those group videos featuring 4 companies that did achieve an operational cash flow positive June quarter. I probably would say one of the reasons I've decided to combine some of these companies in the one video is because they are on the lower quality side, and I don't want to give as much attention to these companies. In saying that, a few companies I have featured in these group videos are much higher quality companies. In fact, a couple of these companies are mining companies that have a market cap of over $1 billion. And the reason they have issued quarterly cash flow reports is they've only recently gone into production and the cash flow has just started to roll in, and those cash flows coming into those mining companies is quite high. Now, before we have a look at the 4 companies I'll be featuring in this video, I just want to give a bit of an update to one of the companies I featured in the previous video, and that company is Delecta. As I was looking through some of the announcements released on the 7th of September, I noticed that Delecta were given a price and volume query by the ASX. Normally, a company is given a price and volume query because the share price of the company has increased on significant volume without any announcements being released by the company. And the ASX just wants to ask the company, are you sure you haven't released all your information that you have available? Because there's no reason why the share price should be increasing by a significant amount on high volume, unless maybe you haven't given all the information to the market. And this is what exactly has happened to Delecta over the past few trading days. In fact, if we look at the past 5 days that Delecta was traded, we can see some abnormalities coming into the trading of this company. So let's go back to the 27th of August, which was a Friday. On this day, only 83,000 shares were traded in this company. And then on the 31st of August, so that means on the 30th of August, no shares were traded at all. But on the 31st of August, when they released their preliminary final report, the amount of shares traded on that day was only 165,000. Not a lot of interest in the final report itself. And then on the 1st of September and the 2nd of September, no shares were traded in this company. And then for some reason, on the last day of the trading week, on the 3rd of September, there were 134 million shares traded. And the share price rose 33%, jumping up only 0.2 cents because the share price on the previous day was 0.6 cents. And that increase in share price on massive volume probably piqued the interest of day traders. And then on the next day, the 6th of September, some day traders got excited and we did see another high volume day, 34 million shares traded. The share price did fall back by 0.1 cents to 0.7 cents. But then on the 7th of September, 485 million shares were traded in Delecta, and the share price rose 86% from 0.7 to 1.3 cents. And this is on the back of no announcements being released by that company. So this just shows you sometimes you will get day traders who look out for a massive increase in volume of the shares being traded in a company. And they got that information on the 3rd of September. So this would have piqued day traders' interest. And that's one of the reasons why we would have seen a massive jump in volume, because unless the company has been keeping something back that they haven't told the market, that's just simple fear of missing out and playing the trade because of an increase in volume. That is one thing I always look for as well, increasing volume, because when you see increasing volume, you know there's a greater amount of participants in the market who are getting excited about a company. A lot of times when you see this sort of action, I won't call it a pump and dump, but it's just day traders getting excited. And day traders' interest doesn't last very long, so they'll become bored within a few weeks, if that at all, more than likely a few days, and more than likely we'll see the share price of the Elector pull back. I prefer to see a massive increase in volume that coincides with a positive announcement from the company. That sort of increase in volume is more sustainable in the long run because those participants in the market who are now interested in that company are interested for a particular reason. Now to the first company I'll be featuring in this video, Aquis Entertainment. This company owns Casino Canberra, which is closed right now. So more than likely this will affect their September quarter results. But if we have a look at their June quarter, $8 million in receipts from customers, and they were operational cash flow positive by $1.6 million. And if we look at the half year numbers, $16.4 million in receipts and operational cash flow positive by $1.9 million. So that could mean this company might be attractive with a market cap of only $36 million at 19 cents. They did begin the quarter with $6 million in cash and finish it with $6.5 million. And even though they do have a market cap of $36 million, they do have $30 million of debt. So you do have to take that into account as well. So the market cap might be $36 million, but their enterprise value is more like near or closer to $60 million. When we look at the cash receipts history for Aquis going back to September quarter 2015, nothing too exciting here at all. In fact, you'd say the cash receipts probably going sideways over the past 5 years. We did see that dip in receipts during the June quarter 2020 when we had massive lockdowns and the casino would have been closed for a long period of that quarter. And then when they did open up and allowed more customers into the casino, we did see a bit of a spike in receipts in the December quarter 2020, which did continue into the March quarter and June quarters of this year. But we did see receipts come back a bit. And more than likely, the September quarter, the current quarter we're in with the casino being closed, won't be quite as good as what we've been seeing the last 3 quarters. And more than likely, it will be probably the second worst quarter this company has experienced over the past 6 years. And whether the market is pricing in that this quarter will not be as good as previous quarters, we'll have to see and look at the chart to see if the market is actually doing that. So let's have a look at the chart right now. This is a fascinating weekly chart, and it's almost eerily similar to what's happening with Delecta now because there was absolutely no interest in Aquis from the start of this chart, which was back in 2014. To the start of 2021, not a lot of volume, share price was not really going up or down. And then in 1 week, in February 21, between, I think it was the 15th and 19th of February, the share price rose 952%. Yes, in 1 week, the share price of this company rose 952%. In fact, on one day, the 18th of February, the share price rose 210%. And then the next day, on the 19th of February, the share price rose 248%. And the share price high during that week was 82 cents. In fact, it rose from about 3 cents to 82 cents. That's a huge rise in share price. And if you're a shareholder during that rise, congratulations, particularly if you sold near the high. The share price has been drifting lower since that time. So over the past 6 months, the share price has drifted from that high of about 82 cents to a current share price of 19.5 cents. And we also have seen the volume come down a fair bit. So really the market hasn't reacted to the possibility right now that the September quarter for this company might not be quite as good as the last 3 quarters and might be more in line with the June quarter of 2020 when they only had $1 million in receipts. Next company I want to look at is Gnosis, and this could be a good company to put on your watch list for the long term because Gnosis is a SaaS software company that offers solutions to boost productivity, collaboration, and information connectivity. They listed in September 2015, so they've been on the ASX for 6 years. If we have a look at their June quarter results, receipts to customers 1.4 million, but they were operational cash flow positive by 187,000. But in saying that, they did receive $615,000 in government grants and tax incentives. If we take that away, this company was not operational cash flow positive in operations. So I don't think you should include government grants and tax incentives because that's really just a one-off. And if we have a look at the year to date, they only received $665,000 in government grants and tax incentives. But overall, in the 4-year numbers, this company was operational cash flow positive by $600,000 on cash receipts of $4.6 million. They also have cash of $6.5 million. So they have a fair bit of cash to go for the future. But the main thing about Gnosis is when you look at the cash receipts, even though we do see a general uptrend in the receipts through time, it's very lumpy. So let's have a look at that lumpiness right now. And at this point in time, just this real bad lumpiness in Gnosis's cash receipts is one of the turnoffs for me. During their life on the ASX since September 2015, there have been actually some quarters where they almost saw no receipts at all. In fact, there was one quarter, the March quarter 2017, 0 receipts. And even if we go to the June quarter 2019, only 145,000 receipts, and in the March quarter 2021, 411,000 receipts. But there have been some quarters where we see a massive spike in receipts, and that was true for the June quarter that we just saw in 21, $1.4 million of receipts. We also have seen in the September quarter 2019 and 20, $2 million in receipts. So I will prefer a little bit less lumpiness to the receipts, but overall the trend is up, and that is a good thing. And with a valuation of only 31 million and an enterprise value of about 25 million, this could be an attractive buy in the future if they can smooth out the lumpiness and remain operational cash flow positive and grow their receipts into the future. As we turn our attention to Gnosis's weekly chart, going back to when they listed on the ASX, nothing too exciting about this chart. We did see the share price in this long-term, well-defined downtrend for about 3, almost 4 years. The share price went sideways. Not a lot of interest in the market. However, we did see a peak in interest late in 2017 and 18, and that was the end of the downtrend. And then we saw another peak in interest when the sentiment in this company changed from about neutral or slightly negative to positive about 1 year ago from September 21. And that share price around then was about 7 or 8 cents. And then we did see the share price rise from that 7 or 8 cents to a high of about 21 cents. But since that high, about 21 cents in January of this year, the share price has been struggling to move up. And one of the reasons it's been struggling to move up is less interest from the market. And you can see the less interest in the market just by the volume traded in this company. It's been dropping since the start of this year. The main things I'll be looking at for this company in the future is just focusing on their quarterly cash flow reports, to seeing if the cash receipts can continue to generally climb up, become less lumpy, and remain operational cash flow positive. Onto a company that's been listed on the ASX since March 2006, and that is Eneco Refresh. Their main activities are the production and distribution of bottled water and accessories. In fact, they call themselves the only bottled water company listed on the ASX. So if you love bottled water companies, maybe Eneco Refresh is the company for you. Ticker code is ERG, and even though they've been listed on the ASX for about 15 years, the market cap is still only $9 million. That's at 3.4 cents. If we look at the June quarter results, $3.5 million in receipts, but they're only operational cash flow positive by $139,000. And if we turn our attentions to the full year results, they were only operational cash flow positive by $580,000. So even though they are producing a little bit of receipts, they have a lot of costs, and all those costs just mean they do struggle to become operational cash flow positive. And one of the reasons we did see the operational cash flow positive at $579,000 was because they received $532,000 through government grants and tax incentives. Now, they don't have a lot of cash on hand, only $1.5 million, so not a lot of attractive things about Eneco Refresh right now, but maybe they have been growing their receipts through time. So let's have a look at their receipts history over the past 8 years or so. This is a slightly interesting receipts history from a company because even though receipts weren't growing between the start of this period, which was the June quarter 2013, and around about the September quarter 2017, in fact, receipts were going sideways. Ever since October or the September quarter 2017, we have started to see receipts growing, and that is actually a good sign for this company. But I think what's been happening over the past 4 years is even though receipts has been growing, costs have been growing along with it at the same rate. So the company remains operational cash flow not positive, not neutral. We'll say neutral at this point in time because they do need help from the government to be operational cash flow positive. So what I would like to see from this company in the future is their receipts or their revenue growing at a faster rate than the costs, so they can become more and more operational cash flow positive as these receipts keep on climbing, if they do keep on climbing. As we turn our attention to Eneco Refresh's chart, which goes back 10 years, so this would be the monthly chart, nothing at all exciting about this chart. So you would not, or you should not, rush out and buy this company based off this chart alone. In fact, if you bought Eneco Refresh 10 years ago, you probably would have paid about 3 to 3.5 cents. And right now, the share price is 3.4 cents. So you've seen no capital growth at all in the past 10 years in this company. That's not what you want to see for a company like this. You want to see the share price growing through time. You want to see capital growth and possibly some dividends as well. I don't think this company issues dividends. So you've seen no returns at all for Eneco Refresh over the past 10 years. And in fact, over the past 9 months, the share price has moved into a downtrend. In fact, the share price has fallen from 6 cents towards the end of 2020 to a current share price of 3.4 cents. So the market is even less interested in this company right now. The final company I want to look at in this group video is Aries. This company is the developer, operator, and provider of early warning networks. That means for their customers or their clients, they provide early warning service for severe weather, natural hazards, and identified threats to business operations. This company has been listed on the ASX since April 2015, and I have been following this company ever since then because I do know about the early warning network as a meteorologist. T code for this company AER, and even though they've been listed on the ASX for about 6 years or over 6 years now, they only have a market cap of $9 million and cash receipts for the financial year of $2.2 million. But if we have a look at the June quarter results, receipts to customers up to $700,000, and they were operational cash flow positive for the quarter by $183,000. And for the financial year, they're operational cash flow positive by $635,000. Unfortunately, they also received almost $700,000 in government grants and tax incentives. And typically when I see that, I take that away from the operational cash flow. And if you do that, they were operational cash flow negative for the financial year. But let's focus on the June quarter. They were operational cash flow positive for the 1 quarter. And they do have $1.4 million of cash on hand at the end of the financial year. So if they can continue growing their customers lists, growing their clients, does seem like there is some good margins in this business. This could be a company to keep on your watch list, particularly if they start growing at a quicker rate than they are right now. So let's have a look at how quick or how slowly they are growing by looking at their cash receipts history since they listed on the ASX. Aries have grown receipts from $250,000 in the June quarter 2015 to $701,000 in the most recent quarter. And when we look at this chart of cash receipts over the last 6 years, there is a general slow upwards trend in cash receipts. You don't want to see an upwards trend in revenue or cash receipts through time. That's telling you that a company is growing, but I would prefer not a snail pace growth in receipts. I would prefer receipts growing at a much quicker rate. But in saying that, we did see a bit of an uplift in receipts from the March quarter 21. Receipts did grow from $520,000 to 701,000. And the main questions I have moving forward, was that growth in receipts a one-off, and will we see the growth in receipts go back to what we've been seeing over the past 6 years in the September and December quarter, so the last 2 quarters of this calendar year, or is this the start of a new growth profile for Aries? That's the main questions I have moving forward for this company. As we turn our attention to the weekly chart for Aries, again going back to when they listed on the ASX, and we haven't seen the share price get as high as the day they did list. The share price at that point in time was about 25 cents. And we did see the share price fall from that 25 cents to a low of 3 cents in 2017. So even though they were growing receipts, the market was not interested in this company at all. A very low volume trade in this company, so low liquidity. We have seen a little bit of interest come into this company over the past few years, and we did see the share price rise from about 5 cents to a high of 19 cents in 2019. And right now, the share price is at 16 cents. And the share price has been trending up over the past 18 months, ever since the COVID-19 financial panic. And right now, the share price at 16 cents is almost at a 5-year high. And a few times when we've seen the share price get this high, back in 2019 and the start of 2020, we did see the share price fall back. And the share price can move through this bit of resistance right now. It's all blue sky ahead for this company, because the last time the share price would have been this high was way back in 2016. That is all I have for this June quarterly report of group video for Gnosis, Eneco Refresh, Aquis Entertainment, and Aeris. If you do have any questions about any of these companies or any other company on the ASX, including Delecta, please leave a comment, question, or your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.